Let's talk bubbles, folks. We've all heard the whispers, the nervous chatter on Wall Street. Is the market about to burst? Is this incredible bull run about to come to a screeching halt? Well, before we hit the panic button, let's break it down. A market bubble, my friends, is like a beautiful soap bubble shimmering with iridescent colors. It inflates as prices surge, driven by hype, speculation, and the irresistible allure of easy money. Investors pile in, intoxicated by the fear of missing out, or FOMO. But remember, what goes up must come down. The bigger the bubble, the harder the fall. So buckle up, because we're about to take a wild ride through the current market landscape, exploring the potential risks and rewards that lie ahead. Hold on to your hats, because the stock market has been on an absolute tear. We're talking record-breaking gains, folks. The S&P 500, the benchmark for the US stock market, has been soaring to dizzying heights. Just look at these numbers. A whopping 24.2% surge in 2023, followed by another impressive 23.3% jump in 2024. This bull market seems unstoppable. It's enough to make even the most seasoned investor do a double take. But what's fueling this incredible rally? Is it sustainable? Well, there are a few key factors at play here. First, we've got the tech sector, which has been on fire lately. And let's not forget about the role of good old-fashioned investor sentiment, which is currently riding high. So let's keep our eyes peeled for any signs of turbulence ahead. Tech stocks, they're the darlings of the market, the engines of growth, the future of our economy, and boy, have they been on a roll. From Apple to Amazon, Microsoft to Google, these tech titans have been raking in the profits, sending their stock prices soaring to new heights. And then there's AI, the hottest topic in tech right now. Artificial intelligence is no longer the stuff of science fiction. It's here, it's real, and it's transforming industries left and right. Investors are pouring money into AI startups and established companies alike, hoping to ride the wave of this technological revolution. The hype is real, folks, and it's pushing the market higher. Anticipated policy changes have also been a major catalyst for the market's recent surge. The winds of change are blowing, and they're blowing in favor of the bulls. Section 4. Riding the wave investor optimism at record highs. The mood on Wall Street is electric. Investors are riding a wave of optimism, their confidence buoyed by the market's stellar performance and the positive economic outlook. Asset managers are feeling super bullish, according to Bank of America, while Deutsche Bank reports unprecedented retail investor enthusiasm. It seems like everyone wants a piece of the action, from seasoned pros to first-time investors. The fear of missing out, or FOMO, is a powerful motivator, driving investors to pile into the market, even if it means pushing valuations to seemingly unsustainable levels. Some analysts believe that this bull market still has legs, arguing that factors like strong corporate earnings, technological innovation, and accommodative monetary policy could continue to propel the market higher. However, others caution that this euphoria might be misplaced, warning that the market might be getting ahead of itself. So, is this optimism justified, or are we headed for a rude awakening? Section 5. Storm clouds gathering. Economic concerns cast a shadow. Amidst the euphoria, there are growing concerns that the party might be coming to an end. Economic storm clouds are gathering, threatening to dampen the market's spirits. Inflation, the silent thief of purchasing power, is rearing its ugly head, eroding consumer confidence and putting pressure on central banks to raise interest rates. The Eurozone, a major economic bloc, is facing its own set of challenges. Germany, the region's economic powerhouse, is grappling with its worst post-war downturn. Italy's post-COVID rebound is fading fast. China, the world's second-largest economy, is also showing signs of weakness, struggling to meet its 5% growth target. These economic headwinds could put a damper on global growth, leading to a slowdown or even a recession. Section 6. The private equity puzzle. Unraveling the risks. While the stock market grabs the headlines, there's another corner of the financial world that has been quietly ballooning: the private equity market. Private equity assets have exploded in recent years, reaching a staggering $13.1 trillion by mid-2023. But this rapid growth has come at a cost. The private equity market is notoriously opaque, shrouded in secrecy and lacking the transparency of publicly traded markets. This lack of transparency makes it difficult to assess the true risks embedded in these investments. Adding to the concern is the rise of private equity credit funds, which have become major lenders to businesses, often with fewer regulations and less oversight than traditional banks. These funds' activities have raised concerns about systemic risks, potentially amplifying shocks to the financial system. Some experts believe that the private equity market could be the source of the next financial crisis. Section 7. A House of Cards? Navigating the Uncertain Future of Housing. The housing market, a cornerstone of the U.S. economy, is a mixed bag of optimism and uncertainty. On one hand, experts predict continued growth in home prices, albeit at a slower, more sustainable pace than in recent years. However, this optimism is tempered by a number of factors that could derail the housing market's upward trajectory. Rising mortgage rates, driven by inflation and central bank policies, could make homeownership less affordable, cooling demand and putting downward pressure on prices. The economic outlook also plays a crucial role. A recession or a significant slowdown in economic growth could lead to job losses, reduced consumer confidence, and a decline in housing demand. Potential buyers and sellers alike should proceed with caution, carefully assessing their financial